Thank you, I would say, once again for inviting me to the International Arab Banking Summit. Here in Paris now, but I have been already in Paris as well, so I mean with the Banking Summit. And it's always a great pleasure really to participate in the dialogue between our banking communities, a dialogue which I believe is absolutely critical for maintaining close links and for increasing cooperation between the European and the Arab region, because you are really our close and good neighbors. So, as you know, the theme of the conference is transitions in the world economy, and in that context, I would like to use this opportunity to focus on some particular transitions in the European banking sector. But before I do so, allow me, for those who have not heard this presentation, a quick word about the European Banking Federation. We represent some 4,500 banks in Europe, indirectly through their 32 national banking associations. So we have 32 full members, 28 EU member states banking associations, and then the banking associations of the 4 EFTA countries, that means Switzerland, Norway, Liechtenstein, and Iceland. And besides that, we have about 15 associate members, like the Russian Banking Association, the Turkish, so countries, European countries, being part of the Council of Europe. Now, we of course are lobbying with regard to the European financial institutions, and we do that already since 1960, so we already celebrated our 50th anniversary 2 years ago. So we have mainly contacts with policymakers in Brussels, with the European Parliament, the European Commission, and the European Council of Ministers, with regulators in London and Paris and Basel, of course, but London because of the European Banking Authority, which is a body that was created a couple of years ago and that is responsible for what we call level 2 banking supervision legislation. So level 1 is really European Parliament who makes the law, but then they can delegate some regulatory competences to this European Banking Authority in London. And the same is true for the European Security Markets Association, the ESMA, based in Paris, which is a committee of the European financial markets supervisors. So with these agencies, we deal, let's say, on a normal basis every day or every week. Just to give you an idea of the importance of the banking sector in the European economy, I would say we are still, even after the financial crisis, the largest banking system globally, and in the largest economic space in the world, with a single market of about 500 million citizens. And in terms of loans to the economy, we make available 25 trillion euro to households, to companies, and so on. Actually, the European banking sector finances nearly 3/4 of the economy, and that is a major difference with the United States, where financial markets have a far more prominent role in funding the economy, where banks account for less than 1/3 of the financing of companies and households. It's a major difference, and that's what traditionally is called the market model, which is prevailing in the US, and the bank model, which is prevailing in Europe. But I think that due to the crisis, perhaps we will come closer, and that also in Europe we evolve a little bit more towards the financial markets, financing the real economy. I will come to that later on. So perhaps I come now to the real theme of my presentation, and referring to transitions, as I said, I would like to use the opportunity to focus on some of the transitions in the European banking sector. Following the outbreak of the financial crisis, the international response, both from the G20 and the European Union, has been rapid and all-encompassing. And I think in modern, and I used to say it in modern history, no other sector has ever faced such an in-depth regulatory upheaval in such a short time. I will not get into the detail of the regulatory, we call it tsunami, in the European Union, with around 30 new legislative acts in 5 years. Among the most important ones, of course, are the implementation of Basel III in European legislation. But I would say the last one, but certainly the most important one, is the European Union's Banking Union project. And I'm sure that will be debated later on in the panel, also by my good colleague Jean-François Pons from FBF. So I will not say too much about that, but I really want to say that the Banking Union paved the way for a proper European framework. It's the first time that we have a supranational supervisor, being the European Central Bank. It will have a lasting impact, I am sure of that. By the end of this year already, so the 4th of November, 280 big banks in Europe will no longer be nationally supervised, but they will be supervised by the European Central Bank. So they will become more and more true Eurozone banks. Actually, it's not limited to the Eurozone. Other non-Eurozone members can opt in the banking union, but for the time being, it's limited to the Eurozone member states. Now, this will, I think, also be significant by the mere fact that we come to this kind of Euro banks, that it will be significant also for the global context, the world context. Now, the creation of a single supervisory mechanism, as we call it, the SSM, that is part of the banking union, is a massive undertaking. It is prepared, therefore, very carefully by what we call a comprehensive assessment. So all these major banks go through an enormous exercise in terms of assessing the assets, the portfolios of the banks. And then after that, jointly, or let's say, or seemingly passing to a stress test, which is, as somebody, I think the governor said, Mr. Boyer last night, compared to the US stress test, this European stress test, well, US stress tests are jokes, I think he told me, yesterday. I will not go so far, but anyway, the scenarios for this stress test are really very harsh. Like, for instance, a scenario where we would have a recession of 7% of GDP, European GDP, which is highly unlikely. But anyway, it is certainly to, let's say, enhance the confidence of not just the financial markets, but also investors, and at the end, the public opinion in the banks. Because this was after the financial crisis, I must say, at an all-time low. So that's what I wanted to say about the banking union, because I don't want to cut the grass before the feet of my colleague Jean-François. What we also think with regard to this exercise is that we should put it also in the context of the actual recapitalization of the EU banking sector. Because since the crisis in 2008, EU banks already have gone through a very significant recapitalization process. And so it's important that this recapitalization is widely recognized, not only by supervisors and financial markets, but as I said, also by investors and the general public, in order to regain their trust and confidence. So banking union, we all are convinced, once implemented, will mark the start of a new era for the European economy, with a sound banking sector where banks across Europe can focus on their core business, that is financing businesses and households. And I also think that the European monetary markets, which for the moment still function suboptimal, will, after this unprecedented assessment exercise, hopefully find a new momentum and catch up with pre-crisis figures again. But is that really going to be the case? Because while sunshine is expected with a banking union, there is another dark cloud on the horizon. Because at the end of January, the European Commission published a proposal to separate the trading activities of major banks in Europe. As you remember, in the US, it's called the Volcker Rule. Now, the criteria that the European Commission envisages would force a breakup of about 30 of the biggest banks in Europe. So a breakup between an investment bank and a commercial bank. As European banks, we are very concerned over this particular proposal of the Commission. We recognize that banks should no longer have to rely on taxpayers' money to bail out failing banks, but we are convinced that there are better solutions to avoid this than the structural reform of banks as it is proposed. Because most crises are related to housing issues, and financing SMEs, as we all know, is also very risky. So what is called the narrow banks, which mainly deal with financing housing and financing SMEs, are by no means safer than what we call universal banks, offering a wide range of services also to corporates. So the proposal on structural reform is also, we think, premature. It leads to too many uncertainties, and we have seen that in the US. The Volcker Rule, it has taken 3 years before the Volcker Rule actually was implemented because of the difficulties to do that. And we want a thorough supervisory assessment first of the impact of such a drastic measure. So we would also like to wait for the results of this comprehensive assessment, as I said, the quality review and the stress test, to actually get an idea of the level of trading-related risks by European banks. We must not forget that the reforms that already have been put in place, and I talked about these 30 legislative acts the last 5 years, they include proper bail-in tools, recovery and resolution planning, capital buffers for systemic banks. So these reforms mean that resorting to bailouts will not be necessary in the future. There are other tools already available. And these reforms, I think, are more apt policy measures, as they do not impact negatively on the ability of universal banks to transform and channel capital flows to where they are most needed in the economy. Structural reform has exactly the reverse effect and should remain the tool of last resort. We are convinced that the financing of SMEs and corporates will be expensive if we have to split between an investment bank and a commercial bank, because the funding of that investment bank will be more expensive than, let's say, the more the funding of the universal bank and the possibility to draw on a large amount of deposits, simple deposits. So we think that when it comes to encouraging economic growth, there are certainly better solutions than that. And the best solution is indeed to focus now on the long-term finance. So we look forward to cooperate with the European institutions on the plans for long-term financing that they proposed in March. We are pleased to see that the European Commission recognizes that banks indeed will continue to play a significant role in the financing of the European economy. And a key element, as far as we are concerned, in the EU long-term financing proposal is sectorization. A well-functioning sectorization market enhances the financial system by enabling a true transfer of credit risk from the banking sector to the wider financial sector, the financial markets. Sectorization can potentially play a decisive role in the coming years to improve access to funding to corporates, and in particular for small and medium-sized companies, in the sense that banks can sectorize their SME portfolios so that they are off the balance sheet and that they can procure new loans to the SMEs, to new SMEs. So that, I think, is the advantage of the sectorization. So it's an important tool for us to optimize the risk management of the banks. In Europe, the sectorization market remains to be reactivated in the wake of the financial crisis and needs to be further developed. According to a joint discussion paper that was published a few months ago by the European Central Bank and the Bank of England, the sectorizations market in Europe is only 1/5 of that in the United States. Compared to the 2008 figures, the level of European sectorization is 30% below what it was then. So there is really room for improvement. To help revive this sectorization market in Europe, we are particularly keen to work with the European Commission on initiatives such as the Prime Collateralized Securities Initiative, known as the PCS. This is a private initiative in which we were a partner, we still are a partner as European Banking Federation. And the aim of that initiative, of which the Secretariat is based in London, is to introduce high-quality securitarized products which are transparent, simple, and standardized. But the revival of this market, of course, is not going to happen overnight. As banks, we are standing by to embrace further change and to participate in the reform processes, because they are critical to the success of our economy, as I said, and the creation of jobs. But much of the eventual success of these reforms will depend on how governments, lawmakers, and regulators will handle them. It's clear that the banking landscape in Europe is going to be very different from what it was a few years ago. The changes that have been introduced during the last 5 years will have a lasting impact, as I said, on banks, as well as on the economy as a whole. And as I already said also, by the end of this year, the biggest banks in Europe will no longer be purely national banks. Increasingly, they will be seen as through Eurozone banks. So this is a significant, also global element. And as European banking sector, we are fully committed to making all these changes work. So I would like to thank you for your attention, But I also would like to thank you all, and especially President Barakat and Wissam Fatou and his team, Mohammed and Munir, from the Secretariat for all the good cooperation all these years. Because indeed, on a personal note, I have to inform you that as of the 1st of September, I will retire from the EBF. I will continue as CEO, because I am that as well for the time being, of Euribor EBF, of which the now, well, we changed the name into a European Money Market Institute, which is the administrator of Euribor, which is one of the three critical benchmarks, being together with LIBOR and TIBOR in Japan. And LIBOR itself is 280 trillion euro in amount of the contracts that refer to Euribor. So it is a critical benchmark, and I hope to dedicate the coming years to, let's say, bringing to a good end this new adventure, because, as you know, since the LIBOR issue, all the benchmarks, and especially these three ones, are under much scrutiny from regulators like the Financial Stability Board, IOSCO, and at the European level, European Banking Authority and ESMA, European Security Markets Authority, I mentioned at the beginning. So I am sure that we will find the opportunity to meet, and at least whenever you look at the Euribor and the rate of the Euribor today, I hope you think of me and remind me. So thanks again, and I am sure that my successor